There's a risk that most property buyers in Australia never put a number on, and it's probably the most expensive one they face. When people think about property investment risk, they tend to go straight to the obvious ones. Interest rate risk, what happens if rates go up? Vacancy risk, what if the property sits empty? Maintenance costs, what if something expensive breaks? These are real. They should be in your model, but they're also the risks that get talked about constantly, which means most investors have at least some awareness of them and some approach to managing them. The risk I almost never hear buyers price in explicitly is the risk of a slow, quiet underperformer. Let me define this precisely. Bad investment property outcome isn't always dramatic. It doesn't always announce itself. Sometimes it's a property that looked fine at purchase, reasonable yield, reasonable location, no obvious red flags, but had structural issues that only became visible over time. A rental market that wasn't as deep as it looked, a supply pipeline that hadn't fully materialized yet, a local employment base that was less diversified than it seemed, an area with genuine amenity constraints that weren't apparent in a surface level review. This kind of property doesn't blow up. It quietly underperforms. It grows below the market median. It sits empty more frequently than expected. It attracts tenants at the lower end of the price range. And while it's doing this, it's sitting on your balance sheet, consuming your borrowing capacity, and preventing you from making other moves. That's the risk, not a sudden loss, a slow one. And the reason it's often the most expensive risk is the opportunity cost. What you could have done with that borrowing capacity over the same period if the asset had been better selected. Let me illustrate with some rough illustrative maths, not as investment advice, but to make the concept tangible. If you have a property worth $600,000 sitting on your balance sheet, consuming a meaningful portion of your serviceability, and it's growing at 2 to 3% per year below the rate a better selected asset might have grown, that's not a small number over 10 years. And more importantly, if that underperformer is blocking your ability to access equity for a second purchase, you're also losing the compound benefit of a second asset that was never acquired. The opportunity cost compounds in both directions. This risk is hard to fully quantify in advance, which is one of the reasons it doesn't get priced in. But the way to reduce it is by being significantly more rigorous upfront about the structural supply and demand indicators. And I want to be specific about what rigorous looks like here. Because do your research is not useful advice at the level of granularity that actually matters. On structural demand, you want to understand the employment base in that market in genuine depth. Not just there are jobs there, what industries, how diversified, what's the trajectory? Are those industries growing, stable, or vulnerable to automation or structural change? Is the population profile growing through genuine economic in-migration or through other factors that may not sustain? On supply constraint, you want to understand what actually limits new supply in this market. Is it geographic? Is there nowhere to build? Is it zoning? The planning framework limits density and lot release. Is it topographic? Hills, water, existing development that constrains expansion. Supply constraint isn't just there's not much on the market right now. That can change quickly. True supply constraint is structure. It's baked into the physical or regulatory characteristics of the location. On rental market depth, this is more granular than vacancy rate. Vacancy rate is a useful indicator, but it's a snapshot. What you want to understand is the density of potential tenants, how many people are competing for the type of dwelling you're buying in that location. And what's the rental price elasticity? If you had to reduce your asking rent by 10% to reduce vacancy, how does that change your cash flow position? On the pipeline, what new supply is coming? Approved developments, rezoning applications, land releases. This matters because rental yield and price growth in a market can look strong right up until a significant supply addition changes the equilibrium. At OV Property Buyers, this level of analysis is what we run on every market before we present it to the client. If you want to understand what that looks like in practice for your situation, book a discovery call. Links below in the description. Now, I want to acknowledge something. The analysis I've just described takes time, expertise, and access to data that isn't always publicly available at the granularity you need. Most self-directed buyers simply don't have the bandwidth to do this at the depth required while also managing their careers, families, and everything else that life throws at them. That's a genuine constraint, not a character flaw, but it does have an implication. If you're going to take shortcuts on the pre-purchase analysis because of time and resource limitations, you need to price that risk into your decision making. The risk of a slow underperformer isn't eliminated just because you don't have time to fully investigate it. You're assuming a risk you may not have consciously signed up for. Best buyers, the ones who build portfolios that held through multiple cycles, are the ones who either did the deep work themselves or worked with people who did it on their behalf. The analysis is the moat. It's what separates a resilient asset from a lucky one. And luck, as a portfolio strategy, has a very poor track record.